The broadcast is now starting. All attendees are in listen-only
Good
mode.
morning, and thank you for joining us for today's webinar, Update on U.S. Tax Reform from an International Perspective. We'll be getting started shortly, but first I want to take a couple minutes to go over the format of today's webinar. If you're attending this webinar for CPE credit, you must answer the 3 polling questions that are presented during the webinar, along with completing the post-webinar survey that will be out with the recording tomorrow. All phones have been placed on mute for this webinar. If you have any questions throughout the webinar, please use the questions tab in the menu. We will address the questions at the end of the webinar as time permits. We will also be recording this session, and the recording will be sent out after the webinar. Again, thank you for joining us. At this point, I'd like to introduce our presenters. As partner in Bloom's Tax Department, Brooke Simpson has over 15 years of repeated success providing tax services and sound strategic planning for U.S. and multinational corporations. In this role, she is responsible for supporting our international clients with matters such as M&A, cross-border structuring, impacts of tax reform, foreign tax credit planning, building shareholder value, and achieving critical strategic goals. As a tax principal, Bella Lichev has over 20 years of experience in international tax and foreign tax reporting for individuals. With a focus on high net worth individuals, Bella is responsible for providing tax compliance and consulting services involving foreign gifts, trusts, pensions, partnerships, and corporations. As a manager in Bloom Shapiro's tax department, James Benjamin has over 7 years of experience providing tax compliance and tax consulting services. His expertise includes tax return preparation services for business entities, as well as tax planning for significant corporate events. At this time, I'd like to hand it over to Brooke Simpson to start the presentation.
Thank you very much, and good morning, everyone. As we get going this morning, let's quickly go over our agenda and the items that we're going to highlight today. We just went through our introduction. We're going to briefly touch on the 965 toll charge and updates that have come out since we had a webinar last year. GILTI, our global intangible low taxable income, our FDII, which we'll talk about in more detail, Section 962 elections, and some FBAR and FATCA updates and overall hot topics and points to be aware of. So highlighting tax reform, what were some of the intentions of U.S. tax reform? Number one was lowering the statutory corporate rate, which we know we effectively have done. One was ending permanent reinvestment. I think historically a lot of companies had foreign operations, and when it came to doing their provision and their audit, the term as we all use is everything was permanently reinvested. And we tried to keep our earnings offshore to try and reduce the U.S. tax on those earnings. There was a shift, and they've called it a territorial regime. I've nicknamed it a hybrid territorial regime with a base protection measure. As we go through today, and many of you are aware, a lot more inclusions are becoming anti-deferral, so how much it actually is territorial we can discuss at another point. We want to protect against our inbound base stripping, so we have beat our 267 CAPE hybrid rules and some interest limitations. There was a transition tax, the 965 toll charge, that accounts for previously deferred earnings before we're switching to this participation regime. So all those earnings that historically have been left offshore, we wanted to make sure got accounted for in our transition under tax reform. And as we'll talk again some more as our FDII, the deduction available to U.S. exporters to lower their effective tax rate to be globally competitive. So some other highlights from U.S. tax reform. Most of the changes, not all, but most are for tax years beginning after 12/31/17. It encourages companies to bring IP onshore and export from the U.S. The corporate repatriation is possible as most income will have been taxed, or it will be eligible for a 245 CAPE dividends received deduction, which we'll talk about in some more detail. And individuals have largely been impacted with the new rules. And so I want to go through some examples that really highlight those factors. So starting at the beginning with 7 key provisions. The corporate tax rate was cut to 21%. It's a flat rate where historically it had been progressive, and it's effective for January 1, 2018. The hybrid territorial, there's a full exemption system for foreign dividends to U.S. corporations. So, and again, limiting this to U.S. corporations. So if a U.S. corporation owns a foreign corporation and those earnings are not coming back as PTI. We have our 245 Cap A. The transition tax, toll charge, Section 965, all the same item. The full taxation of foreign tax, untaxed EMP. There was a 15.5% rate for cash and cash equivalents, and there was an 8% rate for non-cash items. And then our GILTI, our global minimum tax on deferred intangible income. I call this, we'll talk about this in a little more detail, but it's not just intangible income, but it's used in the name. It has an effective tax rate of 10.5% for 2018 through 25, and then it raises to 13.125 starting in 2026. Again, we have the base erosion anti-abuse tax. The BEAT is a minimum tax on gross receipts over $500 million, with some increase in rates over the years noted here. Interest expense limitation under 163J. The deduction for business interest is limited to 30% of business interest income and EBITDA. That was a significant change for a number of us. And our favorable U.S. tax regime for foreign-derived intangible income. And that's the deduction for export sales. I've noted this a couple times already, but this is really trying to help the U.S. become competitive for export sales globally by lowering the effective tax rate on those items of sales and services to 13.125%. So to really kind of emphasize some of the points we're making here, I wanted to give a basic example of $100 of earnings under the old regime and versus the new regime that's going on. So in our examples here, we have a CFC with $100 of earnings, presume no other items, a 15% effective foreign ETR, no traditional Subpart F income, so we're not really focusing on the Subpart F regime that hasn't changed, and a full repatriation of those earnings and a 0% dividend withholding tax. So prior to tax reform, if the CFC had $100 in earnings and $15 of tax, and those earnings were then distributed up to the U.S. parent, it would have $85 of income, a 35% tax on that, and we add the total amount of tax paid by that U.S. company effectively through both itself and the CFC. There was $44.75 of tax on the $100 of earnings. With the new regime under 951 Cap A of GILTI, and presuming that we have 100% GILTI, they had no QBAI deduction, very basic example here, there would be a $15 tax again at the CFC's jurisdiction. However, they would get a foreign tax credit for taxes paid on that GILTI income that would actually create no additional residual U.S. tax, and there would be $15 of tax paid. And then we've proposed U.S. tax reform if the item didn't happen to have any GILTI, if we were, for whatever reason, we didn't meet the regime, we had large tangible assets, and it's probably a very rare example, but just trying to emphasize the point here. If there was $15 of tax paid, the distribution was made under 245 Cap A, eligible, there would be no tax at U.S. parent, and a total tax of $15 would be paid. However, I wanted to do the same example where an individual owned this U.S. parent and it was distributed all the way out to the individual, and to show how the impacts here for an individual are. So in our first example, I probably should have shown I should have shown a picture, I apologize, of an individual instead of my U.S. parent in this picture. But for our U.S. parent will be an individual. And so in our first example, before tax reform and they didn't have Subpart F income, they could have $15 locally paid of tax at that CFC, and then when it was distributed out, the individual would pay, presuming that we were QDI eligible, so those earnings from that CFC were from a treaty country and it would be eligible to a U.S. individual, they'd pay 23.8%, that's the 20% dividends rate, and then the 3.8% NII. And so the total tax paid on those $100 of earnings historically would have been $35. Now, with the GILTI regime impacting here, that same CFC would then distribute those earnings. Before they distribute the earnings to the parent, they'd actually be taxed as GILTI. So the $85 of earnings would be taxed at 40.8%, in addition to the $15 of tax, as individuals are not eligible for our 960 credits. And so their total tax pay would be $50. However, if those earnings were flow-through, and so it flowed directly into the U.S. entity, either through a check-the-box election, through a branch, or another regime, the $100 of earnings at the CFC level would be taxed at 40.8%, presuming the highest individual rate, again with the NII. However, it would be a 901 foreign tax credit that the individual would be eligible for. So the total tax paid would be $41. However, if we compare this with the prior slides, these individuals have significant increases over the old regime. Included here in the slides will be distributed is a summary of some key effective dates, again, for a number of items that we've touched on, noting that what the old rule was, or highlighting, and then the new rule and the effective dates for these regimes. So I think we're ready for our poll question number 1. So everyone should be able to see a polling question on their screen. We must answer these in order to be CPE eligible for our certificates to come out. We'll give just a minute. And while the poll's still open, we'll continue on.
Just skip this.
All right.
Yeah.
Actually, we'll hold just 30 more seconds.
Yeah. All right, last chance here to get your answers in.
All right, so the polling question will be closing shortly, and we'll proceed. So the Section 965, the repatriation transition tax, also known as the toll charge. Just a quick overview. It was a one-time inclusion. It was a required deemed repatriation of accumulated untaxed E&P prior to moving to a dividend exemption system, and it could offset deficits within a shareholder group. Existing foreign tax credits that a taxpayer had can be used to offset the toll charge, but they are subject to a haircut. So the foreign tax credits at the CFC level, when the deemed inclusion happened, were haircut. The amounts are tested as the higher of the E&P as of November 2nd or December 31st, 2017, and it was just the 2 testing dates that had to happen. Payment could have been spread. You can make an election to pay over 8 years. And the effective tax rate on that deemed inclusion really depended on the CFC's cash position. It was a 15.5% for cash and other liquid assets, and it was 8% for all other assets. And the inclusion depends on the CFC's year end for U.S. tax purposes. Toll charge is for the last taxable year that begins before January 1st, 2018, and pickup is in the U.S. tax return for the applicable year end of that return. That was a quick overview of what the toll charge is. Some updates, some final regulations were released on January 15th, 2019. Commodities held, actually they were proposed regulations. Commodities held as inventory or supplies and hedging transactions related to such commodities are generally excluded from the cash position definition. Bona fide hedging transactions that hedge an aggregate risk may be created as cash equivalent asset transactions. It extended the time period in which taxpayers falling under the transition rule may make the basis adjustment election. Also, there was a couple notices that were issued to try and block some creative tax planning, specifically the year-end change that many taxpayers had been reaching out to do to delay the toll charge. The one highlight that many are applicable for this year is the requirement of a taxpayer to file Form 965 with your 2018 return. So if your toll charge inclusion happened in 17 or 18, you still have to file this return with your 2018 tax return. So even if it was picked up last year on the 17 return, please remember to file Form 965 with your 2018 return. In addition, Section 965 includes statutory due dates for making the H election, the I election, the M election, and Section N elections. A number of these elections would be, your payment over 8 years, your election to not use your NOLs to offset your toll charge inclusion, and there is not relief available under these regulations of 9100 if they are not timely filed. So I was handed over to James to introduce our global intangible low tax income.
Thank you, Brooke.
So this is James Benjamin. As mentioned earlier, I'm a tax manager in the firm's compliance group, and I do a fair amount of deal work as well. And with that deal where GILTI's certainly come up in performing diligence, at least with respect to 2018. So high level, just to keep a few things in mind, just because you have some controlled foreign corporations in your structure that may have a deficit of E&P, that doesn't necessarily mean that you won't have some GILTI exposure going forward. Conceptually, it's supposed to catch, it's supposed to be a proposed minimum tax, but it can still catch taxpayers with an effective foreign tax rate in that jurisdiction above 13%. So normally, for a lot of our clients operating in the UK or other tax jurisdictions with a rate maybe around 20%, after you factor in the foreign tax credits and the deductions from FDII, which we'll talk about later, you wouldn't necessarily expect to have a cash tax exposure resulting from those operations. So I just, again, thinking through sort of the calculation and how it works, the way I like to approach it is I like to start with at least looking at a P&L of each CFC, especially as we head into 2018 extensions. And what you want to look at is it's a concept called net tested income with respect to each CFC. And what you're going to do is you're going to take the net tested income and loss of each CFC and aggregate those two together. And if it's a positive number, you'll need to move on to the next step. But net tested income is defined as the excess of the aggregate of a shareholder's pro rata share of tested income of each controlled foreign corporation over their pro rata share of tested loss of each controlled foreign corporation. So for a lot of our clients, they own 100% of the foreign subsidiaries they're setting up. But if you own less than 100%, you'll need to factor in what your pro rata share is. Now the gross income itself, or the tested income itself, or the tested loss, you start with gross income. You're going to back out a number of items that are related to things like subpart F income, effectively connected income, or income that's excluded under the high tax exemption. And then you're going to subtract out from that gross income the deductions that are allocable to such gross income under rules similar to Section 954. So for a lot of our clients that may not have sub-F income or ECI, the starting point just to see if it's even a concern, again, is maybe you take a P&L for each CFC. You sort of ballpark. Does it look like I have a net tested income or a net tested loss when I add everything up together? The next step, what you want to do is for any subsidiary where you have tested income, you also get to back out from that number something called QBAI, or Qualified Basis in Assets, which is on the ADS system, or Alternative Depreciation System. What's nuanced about the ADS system is the rules generally call for a tax life longer than what you would get out of makers. So in some instances, you will need to recompute the tax basis of those CFC's assets on a different depreciation system than they may currently be on, at least for local country purposes. And it's important to keep a note too when you're doing this analysis for QBAI, the way the rules are written, you're only looking at the QBAI of your CFCs that have tested income. And to the extent that you have property in those CFCs that have tested income that are used in the production of tested income and not used in the production of tested income, you'll need to prorate your basis in that property. So there are proposed regs that are issued that have some additional rules and examples. They're very technical in nature. There are also some anti-abuse rules that were issued as well. We can talk a little bit more about that in the next slide, but conceptually, the anti-abuse rules were put into place to limit a taxpayer's ability to buy, sell property amongst its CFCs in order to create additional basis or in order to trigger losses or gains that may be advantageous in computing a GILTI inclusion. And high level, there is a principal purpose test that looks to what the principal purpose was for engaging in these transactions. So if it does appear to a reasonable third party that the transaction has no substance other than to reduce your GILTI liability, it's very likely that the IRS could recast the transaction. So that's sort of conceptually high level. That's GILTI and that's QBAI. Brooke, did I miss anything? Does that sound all right?
Very, very helpful.
Okay. So I'd like to talk a little bit about FDII, or Foreign Derived Intangible Income. I think this is the first time someone said FDII to me, I didn't really understand what they were talking about, and then I actually read 250 in a little bit more detail. So what FDII does at a very high level is it gives a U.S. taxpayer an additional deduction for goods or services that are provided to an end user in a country outside the United States. And I think the genesis of FDII is you still have a lot of countries, Ireland, for example, that have a tax rate in the low teens. And what FDII does in a perfect world is it gets your taxable income or your effective tax rate on those foreign sales closer to 13%. FDII, much like GILTI, also has QBAI at the heart of its calculation. So on this slide, we included, and I don't want to skip around too much, but FDII right now, to the best of our understanding, it's only available to C corporations, and the one, I guess, nuance that's still out there is maybe you have a partnership that is selling outside of the United States, and maybe that partnership has a corporate partner. There's still a little bit of ambiguity or uncertainty as whether or not that corporate partner would be able to take its allocable share of Section 250 items and compute that deduction at the entity level. So we have the way you calculate it at the very bottom of the screen. So your foreign derived intangible income is going to be equal to your deemed intangible income multiplied by your foreign derived deduction eligible income divided by your deduction eligible income. So the way I like to explain it, at least a lot of my colleagues here, is I think the first part, and keeping in mind there aren't regulations even proposed or temporary issued around FDII at this point. So there's still some ambiguity out there, maybe some uncertainty as you calculate it. But I like to start with your DEI, your deduction eligible income. And your deduction eligible income is generally going to be your gross income computed without regard to certain items like sub-F income, ECI, very similar to what we were just talking about with GILTI. And then once you have that gross income number and you've made the appropriate adjustments, you're going to subtract out the deductions that are allocable to that gross income, and that's your DEI. Your foreign derived deduction eligible income is basically that portion of your DEI, which is for sales or services to customers outside of the United States. And in a perfect world, you would have all the information to know what expenses, if any, are allocable to those foreign sales, which is essentially what you're trying to get to with your FDDEI. The way we're sort of shortcutting it for purposes of our extensions is we're looking at a net income margin based on your DEI. So if I think about DEI in the context of we don't have any sub-AF, there's no ECI, there aren't really any adjustments out there. If I look at page 1 of my 1120, I'll look at line 10 or 11 gross income, and then I'll go all the way down. I'll look at my total deductions, which will get me to a net taxable income number. And if I divide that net taxable income number by my total gross income, That'll get me a margin, a net taxable income margin. And if I multiply that margin by my foreign sales, that might be a pretty respectable ballpark of what my foreign derived deduction eligible income might look like if I had all the information to determine it, which again, for a lot of our clients and for those of us in industry, may not always be the easiest information to extract. So once I have that fraction in place, I need to calculate my deemed intangible income. My deemed intangible income is going to be my deemed tangible income return, it's going to be my deduction eligible income. That's my deemed tangible income return. So we just defined DEI. The deemed tangible income return is your QBAI. Is your QBAI. So once you have that in place and you can do the math, your deduction is going to be 37.5% of what that works out to. And again, the genesis of the purpose is to try to get you to a lower effective tax rate that might be in line with what you might experience if you are incorporating an entity in Ireland and selling out of Ireland. There are a couple of additional rules you want to be cognizant of if we flip to slide 22 here. There are additional records you'll have to keep, at least as far as who your end user or who your customer is. In drafting the legislation, I think there's some concern about selling to related parties outside of the U.S. And if you do sell to a related party outside of the U.S., the issue is where's that property going? Is it coming back into the U.S., in which case you're abusing the purpose behind the rules? Or is that property being used in the furtherance of manufacturing, or is it being sold within that country? So again, that's something you probably want to be cognizant of. As long as those sales are leaving the U.S. and they're not going to a related party, you shouldn't have any issues. If they are going to a related party, an entity organized outside of the United States or domiciled outside of the United States, I think in that case you'll need to work with your local country finance teams to understand where those sales are actually ending up, and you certainly want to confirm that they're not making their way back into the United States. I think that's all I had on FDII. I'm going to hand it over to Bella now, or Brooke for 962 elections.
Thank you very much, James. So there's been a lot of talk in the market about 962 elections, so we thought it'd be really helpful to kind of give an update on that. So I think, with the creation of the new inclusion under GILTI, and as we previously, gave an example earlier on and how it can really impact individuals, many individuals are finding income from foreign holdings that wasn't currently included and had deferral now being picked up at their ordinary income rates. And so, what are some solutions to these problems? One is if you hold less than 10%, we may want to do some structuring alternatives, such as, is it worthwhile to put a foreign holding company in place or a U.S. holding company to minimize the impact? U.S. individuals that hold greater than 10%, so to be eligible to make a 962 election, you must be a U.S. shareholder. So you'd have to hold at least 10% directly or indirectly. And it can be held through a partnership. They may benefit from making an election under 962 to treat all of their 951 little a income, and for purposes of 962, 951 cap A, so your GILTI income is included in your 951 little a income, as taxed at the corporate tax rate at 21%, and are eligible to use foreign tax credits on that income, where historically or under normal circumstances individuals can't use foreign tax credits against their income. In this circumstance they can. And individuals may also want to consider making a check-the-box election. So if the 962 election isn't going to be beneficial, does it make sense to make a check-the-box election like we did in our prior example for an individual, for the entities to be treated as disregarded and flow through, where 962 may not be desirable either due to not being QDI eligible income or some state tax implications that we'll talk about further. I think what's really important here is that it's really an analysis that individuals need to analyze what this election would be and how it would impact their return. As there's not really a mold, it really is going to be a facts and circumstance scenario. What are some overviews for these? Again, it's potential tax savings. It can significantly reduce the U.S. tax costs under the GILTI regime and possibly Subpart F, because you'd be able to utilize a 21% corporate tax rate on those income and FTCs. It's likely a good solution where most GILTI or Subpart F is from CFCs that are qualified foreign corporations and for qualified dividend income purchases, meaning they generally have to at least have a treaty and be eligible for the treaty, meaning the LOB and other clauses, your limitation of benefit clauses, and are expected to generate significant GILTI or Subpart F income with moderate to high effective tax rates, and state taxes do not negatively impact. So there's a number of scenarios in which, like New York State, where the income tax rate is so high when you do the double inclusion, it actually does not become beneficial. Connecticut and Mass may not be that beneficial. Obviously, if you're in New Hampshire and don't have income tax, that definitely could be a scenario in which it would be beneficial. Again, what is a 962 election? It effectively allows individual 10% U.S. shareholders to be taxed on GILTI and Subpart F inclusions as if they were invested through a U.S. corporation with these lower tax rates of the 21% that got enacted through tax reform. They are taxed as if they were a corporation, and again, utilize foreign tax credits. However, what's really important is that distributions of related earnings by CFCs so under normal circumstances, once you have an inclusion, those earnings become PTI. But then when you have a future distribution on those earnings, they are then taxed again, and they are only PTI eligible, so previously taxed income eligible, to the extent U.S. tax was paid on those inclusions. I have a slight example that we'll go over in the past, but this is a real key to the 962 election. And another element of it is the benefit of the time value of money, because often you can defer your current inclusion with your FTCs and have the pickup down the road. I also want to highlight with 962 elections that they were, Section 962 of the code was enacted, ironically, in 1962. But what's important about that is that it's been in place way before our QDI regime and way before tax reform. So some of these implications that are happening were not really thought through when it was put into place, and it's something to be cognizant of. So some key awareness points, again, still building on this. The election is made annually on a U.S. individual's tax return, so you're not tied in for a number of years, and it's also on the tax return, so you have all your information. You can decide at the end of each tax year, based on your actual information and analysis, to evaluate whether it makes sense for that individual. So you run all your numbers and say, will this say, what will the tax be and will it benefit me? 962 elections are only available for individuals who are themselves 10% U.S. shareholders of the relevant CFC. Again, noting that you can hold it through a partnership, but this U.S. shareholder must own at least 10% directly or indirectly. It applies to all 951 small A income, including GILTI and Subpart F, with respect to the individual as a U.S. shareholder. So it's an all or nothing inclusion, meaning you cannot cherry pick. It cannot pick certain CFCs that you want to make the election on. It's all of your 951A income for which you're a U.S. shareholder that would be picked up. So really you need to look at your portfolio, and does it make sense for you as an individual? Some of the other main factors is whether the CFCs, again, are QFCs and they have for QDI purposes, because you want that beneficial 20% rate and not to be taxed on that second inclusion at ordinary rates. If most GILTI and Subpart F inclusions are QFCs with moderate to high foreign ETRs, then the 962 election may have tax savings. But however, I really want to highlight here, it depends on the state residence of the individual due to that second inclusion. I've had a number of folks say, well, okay, but if I plan to retire in Florida where there's no income tax down the road, then it may be, a good solution for me, which is entirely true. Under the current rules, it's really about that second layer of tax on that second inclusion, because just as corporations have 2 layers of tax, with 962, the code is written so that there'll be a second inclusion. As of right now, until further clarification is provided, Section 250 deductions for GILTI, which we didn't really focus on much earlier, but under Section 250, there you get effectively a 50% deduction for your GILTI inclusion, which is how you get your effective tax rate down to 10.5%. It is not allowed for individuals making 962 elections. There was some debate when the rules first came out whether they would change that, but I think our feeling is right now that it's not likely to see this relief for 250 deductions under 962 elections. So I really kind of wanted to walk through an example here again because I thought this was the best way to show this. So in our basic example, you have GILTI income of $80. You have an individual rate of 40.8%, right? So your U.S. tax on that inclusion would be $33, and your mass tax would be $4. When you actually made a distribution down the road, right, you'd already paid tax on that inclusion, right, because it would be PTI when it was distributed. So your total taxes paid on that original $80 of income would truly be $57. However, let's go to example 2 where we made a 962 election. The income is QDI eligible and there is no 250 deduction. So we have, again, $80 of income. You have an FTC of 20. That GILTI inclusion, we're taxing those earnings as if they were taxed by a CFC. So the FTC gets an 80% haircut, so your FTC gets reduced to 16. Your corporate tax rate is 21%. So with our gross up, we have an inclusion of 100 because we have to do a 78 gross up on those foreign tax credits at their full amount. So you have $100 of earnings, and it'll be taxed at $21. And then we have the U.S. federal tax of $5 and the mass state tax on GILTI of $4. You'll have your foreign tax credit that potentially offset your U.S. federal tax. So later when we distribute the earnings down the road, there would be, so apologies, there was $21 of U.S. tax, 16 was your foreign tax credit usage with after your haircut. So you actually had a residual tax of $5 paid currently. So when we go to do our distribution down the road, we have $80 of eligible earnings to be distributed. We will have PTI of 5. Since we paid 5 on the initial inclusion, there'd be $5 that would be eligible for PTI. So your taxable distribution will be $75. Your individual tax rate, presuming that you get the QDI rate and NII, would be 23.8%. So you'd get a U.S. federal tax on GILTI of 18. Your mass tax again would be 4 because you'd have that inclusion again. So your total U.S. tax state and U.S. federal tax paid is 31. Your total foreign tax paid is 20. So your total taxes paid is 51. So in this example, with a 20% effective tax rate, you actually have $6 in savings. Our second example here is where we have the same analysis for our initial QDI election, right? So we have the $80, our foreign tax credits of 20. Our haircut again is at that 80%. And so we have a $21 of tax and we have $4 of mass state tax. In this example though, you don't have QDI, so you have a CFC that wouldn't be QDI eligible, such as Brazil. Our earnings were from a Brazilian entity. So when down the road, these 962 earnings are distributed down the road, you still only have $80 of eligible income to be taxed, and we have the same PTI of 5 as that we've had historically. So your taxable distribution is still the 75. However, you don't get the beneficial rate of 23.8%, and you're at the highest individual rate of 37 plus your NII, which gets you to an effective rate of 40.8%. So your U.S. tax on that second distribution ends up being 31. Our mass tax stayed at 4. So our total state and U.S. tax is 43, but our total foreign tax is 20. When we add those together, it's $63 of total taxes paid, which are actually, largely in excess of the original $57 where you made no 962 election. So that's why it's important to really make sure that we know our state tax implications and that they're QDI eligible, because in this scenario it would actually be, you'd be worse off by making the 962 election than had you not. So I think we're ready for our second polling question. Again, they should be appearing on your screens. We'll give just a minute for everyone to read the question and review the answers.
Just a few more seconds here. Again, if you are taking this webinar for CPE credit, you must complete all 3 of these questions.
All right, I think we're wrapping up right now. The question will be going down, and I'll be handing over to Bella to talk about FBAR and FATCA hot topics.
Thank you, Brooke. Good morning, everyone. So I will touch on the FBAR and the FATCA reporting requirements. I'm going to start off by some background why we have to worry about FBAR reporting and FATCA. So U.S. law has always required U.S. citizens, including dual citizens and U.S. residents, to declare and pay taxes on all of their worldwide income, regardless of where these earnings have been derived. Historically, though, some U.S. taxpayers have attempted to avoid or evade reporting income earned outside of the U.S. because of the United States government inability to identify those earnings from overseas banks and other financial institutions. So the Internal Revenue Service and Department of Justice have intense focus on curtailing the offshore tax avoidance via 2 main mechanisms: the Foreign Bank Account Reporting and the Foreign Account Tax Compliance Act, which are designed to put an end to the tax havens and banking secrecy. So who must file an FBAR, Foreign Bank Account Report? This is Form FinCEN 114. A United States person required to file Form FinCEN 114 if the U.S. person had a financial interest in or signature authority over at least one financial account located outside the United States, and the aggregate value of all foreign financial accounts exceeded $10,000 US at any time during the calendar year reported. The Department of Treasury publishes annual interest rates for currency rates for conversion of the foreign balances. U.S. taxpayers with foreign accounts have 2 obligations. They have to answer the question, they have to declare that they do have a financial interest in signature authority over financial account. And that question appears not only on the individual tax return, which is on Form 1040 Schedule B, Part 3, but it also applies to other applicable forms and schedules for different types of tax returns filed. And the U.S. taxpayers are required to, if they do have reporting obligation, they have to file electronically FinCEN 114. It used to be the FBAR was filed paper by paper, but now it's required, it's mandatory electronic filing, and it's due April 15. It can be automatically extended until October 15. So what is a financial account? The definition of a financial account is very broad, and it includes the following type of accounts: bank accounts such as savings accounts, checking accounts, and time deposits; securities accounts such as brokerage accounts; commodity futures or options accounts; insurance policies with a cash value; mutual funds, similar pooled funds; and any other accounts maintained in a foreign financial institution. A United States person, it means a citizen or resident of the United States, an entity created or organized in the United States or under the laws of the U.S., and the term entity includes but is not limited to a corporation, partnership, and limited liability company, or a trust to estate formed under the laws of the United States. When we talk about the U.S. resident, it's important to note that it doesn't only mean a green card holder. Even if you don't have a green card, if you meet the substantiated presence test, if you're here long enough in the United States, you may fall under the definition of a U.S. resident for tax purposes, which would trigger FBAR filing obligation. There are also certain instances where a non-resident alien make elections to be taxed as a U.S. resident, for instance, for purposes of joint filing with a U.S. spouse. That will also require an FBAR obligation for a non-resident alien. A U.S. person has a financial interest. It's defined if in the following situations. The U.S. person is the owner of record or holder of legal title. The owner of record or holder of legal title is a person acting as an agent, nominee, attorney, or person acting on behalf of the U.S. person with respect to that account. Or if the owner of record or holder of legal title is an entity in which a U.S. person owns directly or indirectly more than 50% of the voting power, total value of equity, interest, or assets, or interest in profit. Signature authority is the authority of the individual to control the disposition of assets held in the foreign financial account by direct communication to the bank. Jointly held accounts. If you have a jointly held account, then each person is considered to have a financial interest in that account, and each person must report the entire value of the account on an FBAR. And there's also modified reporting if you have more than 25 accounts, interest in more than 25 accounts. You don't have to list them all. You just have to check the box that you have more than 25, but you do need to keep records of the information. So there are some filing exemptions. For instance, if you own jointly accounts with spouses, so only one FBAR is required. Correspondent or nostro accounts owned by banks, U.S. government accounts are not reportable, IRA owners and beneficiary accounts, participants, beneficiaries of tax-qualified retirement plans, accounts maintained at U.S. military banking facilities, individuals with signature authority only if an officer employer of a federally regulated bank, publicly traded company, SEC regulated financial institution, or registered investment company. Here, this chart shows the penalties for failure to file an FBAR. It's a very high penalty sensitive form, and depending on the type of violation, whether it's negligent, non-willful, willful, civil and severe civil and criminal penalties can be imposed. The other mechanism of trying to fight this anti-evasion is the FATCA, the Foreign Account Tax Compliance Act, which was passed by Congress in 2010 and became effective July 1st, 2014. And this requires foreign financial institutions to annually disclose account information regarding U.S. customers or face 30% withholding tax penalty on U.S. source payments. FATCA has been largely embraced globally. More than 165,000 foreign financial institutions have registered with the IRS to become FATCA compliant, and more than 110 countries have agreed to bilateral treaties to fully implement FATCA. So it requires foreign financial institutions to report to the IRS information about the financial accounts held by the U.S. taxpayers or by foreign entities in which U.S. taxpayers hold a substantial ownership interest. In order to avoid withholding under FATCA, a participating FFI will have to enter in an agreement with the IRS to identify the U.S. accounts, report certain information to the IRS regarding those accounts, and withhold a 30% tax. So not only the foreign financial institutions have foreign reporting obligation under FATCA, FATCA also requires U.S. taxpayers, specified individuals, and specified domestic entities with specified foreign financial assets that exceed certain thresholds to report those assets to the IRS. And this is where the infamous Form 8938 comes into play. So what is a specified foreign financial asset? It includes financial accounts maintained by foreign financial institutions and other foreign financial assets held for investment, such as foreign stock or securities, interest in a foreign entity, any financial instrument or contract that has an issuer or counterparty of a non-U.S. person, foreign pensions, deferred compensation plans, and certain foreign trusts and estates. A specified individual is a U.S. citizen or resident alien, and just like I mentioned before, a non-resident alien who makes an election to be treated as a resident alien for purposes of filing a joint income tax return is also included. A specified domestic entity is a closely held domestic corporation partnership that has more than 50% of passive income or assets held for producing passive income. So the reporting thresholds: if you're single or file separately from your spouse, you must submit the Form 8938 with your individual tax return. If you have more than $50,000 of specified foreign financial assets at the end of the year, or more than $75,000 at any time during the year, and you live in the United States. If you file jointly, those thresholds are doubled. If you live abroad, the thresholds are much higher. It's $200,000 on the last day, or $300,000 at any time during the year. You are considered to live abroad if you're a U.S. citizen whose tax home is in a foreign country and you have been present in a foreign country for at least 330 days of the year. Form 8938 is part of the tax return, and there's an exception for filing. If no income tax return is required to be filed, then no Form 8938 is required to be filed either. Unlike the FBAR, it's important to note that for FBAR, even if you don't file an individual tax return, you are required to file FBAR if you meet the thresholds. Exceptions from reporting. A financial account maintained by a U.S. payer, meaning a U.S. payer includes a U.S. branch of foreign financial institution. So if it's, this exception is not available for FBAR reporting. So if you have a financial account located outside of the United States, foreign branch of a U.S. institution, that is reportable for FBAR purposes, but not for Form 8938. Another exception is a beneficial interest in a foreign trust or foreign estate if you do not know or have reasons to know of the interest. An interest in a social security, social insurance, or other similar program of a foreign government. There's also some accepted specified foreign financial assets that are listed in Part 4. These are trusts and foreign gifts already reported on Form 3520 or Form 3520A, excuse me. Foreign corporations reported on Form 5471. Passive foreign investment companies reported on Form 8621, and foreign partnerships reported on Form 8865. If you have any of those situations and you've already filed those forms, all you have to do is check the box next to them and indicate the number of forms previously filed. This slide here shows the non-compliance, the penalties for non-filing Form 8938. Just like the FBAR, it's a very high penalty sensitive form. It's 10,000 failure to file and an additional penalty of up to 50,000 for continued failure. It also extends the statute of limitation to 6 years if you omit gross income from more than 5,000 that is attributable to a specified foreign financial asset. The penalties may be abated if you show reasonable cause, and it's determined on a case-by-case basis. Just like I said before, Form 8938 does not relieve filers of FBAR filing requirements. So sometimes some of the it's almost like a duplicative foreign financial assets reporting, but the information required to be reported on both forms is not identical in all cases. And now we're going to launch poll question number 3.
Again, if you're attending for CPE credit, you must complete all 3 of these polling questions. This is the 3rd and final one. About another 10 seconds or so here.
Okay. This slide here, I found it's very useful. This is actually a chart straight from the IRS website that compares the Form 8938, the FATCA form for individuals and specified domestic entities, and the FBAR FinCEN Form 114. So as you can see, there are certain differences depending on the type of financial asset, whether it's reportable on one or both of these forms. So I've been saying that these filing obligations and these forms are very high penalty sensitive forms, and certainly there are taxpayers who have not been compliant, and there are certain options available for U.S. taxpayers with undisclosed foreign assets. Probably most of you have heard of the 2014 Offshore Voluntary Disclosure Program, which was designed for taxpayers with exposure to potential criminal liability and substantial civil penalties due to willful failure to report foreign financial assets and pay tax due on those assets. That program closed on September 28, 2018, and currently there is an interim guidance memo which applies a civil resolution framework. The second option, which is when you have non-willful conduct, it's streamlined filing compliance procedure. That procedure is a lot more simplified than what the OVTP was, and it requires amending 3 years of tax returns and 6 years of FBAR, plus the offshore penalty is only 5% or 1% if you live abroad. There's also 2 delinquent informational foreign reporting procedures. The first one is delinquent FBAR submission procedure. No penalty will be imposed if the taxpayer properly reported and paid tax on all income from the foreign financial accounts, but just missed to report the FBAR. One very important requirement is that the taxpayer must not have been previously contacted by the IRS to be able to be eligible for this procedure. And the delinquent international information return submission procedures, this is good for all the other foreign informational reporting forms, such as Form 5471, 8865, 3520. Again, the taxpayer needs to establish reasonable cause not have been previously contacted by the IRS, and there's no guarantee that the penalty will not be imposed.
Thank you, Bella. We want to thank everyone for joining today. I think we've probably reached pretty close to our time. However, if you do have any questions that you'd like to follow up with, please feel free to reach out via email, and we're happy to take those questions and respond directly to you.